Here we're going to go abroad and look at what's happening in terms of Russian flows, what's happening in terms of physical flows, and more importantly, refined products. Because as Russia puts more refined products into the market, it's going to shift things a bit more because does it make sense to buy Russian product versus Russian crude because the product is already cheaper? If I try to buy Russian crude as well as blend it with others, I'm going to be higher than some of them. So again, there's this back and forth in terms of how Russian product is going to continue to kind of, murky the waters of some of these underlying flows. And here is, I think, an important one when you look at Russian Urals, the discount to Brent. You can see that the discount remains very wide, and they're trying to put more product into the market, but they've reached a saturation point. They're putting some crude into storage in Turkey. They've announced putting some storage into Ghana. That is creating some strife, and now Ghana is being asked to explain why. So oil to be stashed in Ghana's pool of buyers shrinks. Tanker Thesis arrived in Ghana's territorial waters. It's the volume of Gasoil type fuels loaded from Russia and signaling India reached a record in February following the ban. So we essentially have a saturated crude market, I should say demand for Russian Urals. Now we see that there's a big impetus to buy. Well, Russian product is now available. And that's going to be some of those important shifts, which is why we talked about where Russian crude goes, where U.S. product goes. So Russian crude is going obviously well into Asia. You're also seeing their product go into Latin America, Africa, and Asia. And the U.S. sends a lot of our product to Latin America. So if it's not going there, where's it going to go? Is it going to go into Europe? Europe sends some of their gasoline and fuel oils into Africa. Are they going to need to do that given where some of Russian product is? Because Russian product's going to be much cheaper. And as those flows continue, you're going to see some of these shifts. And India has had a big step down in buying of Middle Eastern, West African, and U.S. crudes, which is obviously putting more product on the water just because, and just less buying, which is why differentials have been, finicky. You've had some waves of buying, then they go away. There hasn't really been this consistent move of purchases, and a lot of this is driven by the surge in exports. And the HSFO, the high sulfur, as well as the SRFO, is going to be important to watch because look at the increases. So you can see that that blue piece of the bar is getting bigger. Now, the exports of Russian crude and fuel oil to Asia's top economies expand, but there's only so much shipping capacity and export capacity Russia has. They also don't have the same amount of storage. Why? Because if you think about storage, the US and China have a lot because we import, we have buffers. We also don't produce enough for ourselves, so we need to have excess. Russia produces way more than they consume. They had a ton of pipeline capacity, a very robust pipeline network, which enabled them to keep flows fairly stable. So their need for excessive storage was limited. But now they need storage, but you don't just snap your fingers and build a tank farm. And that's creating some of these problems where they need to push as much as they can out, but you only have so many slips. You can only fit so many boats in one area. You can only fill a boat so fast. So all of these timing issues create a problem. What they are trying to do, which is something that we showed here with some of these new barrels at sea, is create a buffer where it's like, all right, well, we'll get all of these ships. We'll say that the destination's unknown. We'll park them out here, and as we sell them, we can send them out, and we can try to create a little bit more of a buffer between the two, which is something that is going to be an interesting one to watch because it's also expensive. But you're already seeing people not willing to pay, obviously top dollar, so they have to sell at a discount, plus they have to pay to have this on the water. And again, all of these things eat into underlying margins. Now, when we look at the Middle Eastern crude oil, you can see it's still staying at the high end. It's near the 2022 levels. And this is that continuous problem that we've been seeing. And if you remember, the numbers were a bit worse And sometimes this can happen when you're looking at some of the data sets because how is it being calculated? How is it being filed? Did the polygon change? Some of these things, then you can get these movements up or down. Or did something get reclassified? And that's where when we see some of the different flows, you have Europe not buying the same level as we've talked about. You have the Asia not buying to the same level. And that's going to be a lot of consistency in terms of just the Middle East is going to have to cut pricing. When you look at total crude exports from the U.S., we had a big bounce in the 4-week rolling average to just over 4 million. Again, we expected to be between that around 3.8. When you look at gas oil spreads and crack spreads, you can see that it's a slight uplift to about $26.76. But the important piece is it's well below 2022 levels, but it's still strong compared to 2018 to 2021. This is the one to watch. If this starts to come down, which we think it does, we think it'll bleed back down to about 20. That's when you're going to start to see a lot of pressure and run cuts on non-China entities. So China has a lot of export quotas available. They have the local demand, but they have the ability to push this into the market. And as they push into the market, mixed with Russia pushing into the market, well, can South Korea compete? Can Singapore compete? Can Japan compete? Can other areas within the ASEAN compete? And then if India can't, well, then you'll start to see some of those run cuts, and that will balance out where even if you get this big increase in China demand, you'll see some of that diminishing in other areas. So then when you look at the Dubai swap versus Brent, it's at $2.46. Again, we don't see it adjusting too much. You did get Abu Dhabi's Murbayne futures rose to a premium. That has come back a bit. And now you're starting to see it level off. And we just don't see it moving too much in any one direction, given some of the slowdown in purchases from the Middle East. Global crude oil on the water still remaining elevated, but obviously it's going to bounce around. A lot of that is going to be driven based on Russia, and then the length of time it's at sea. Length of time it's at sea, it's going to keep that crude oil in transit elevated. We don't see that changing. And here you can see that there's been a bit of a pivot higher in floating storage. But again, very close to where we were in 2022, which is very much in line with some of our expectations. That's why last week when we saw some of the bigger drops, it ran counter to some of the things we had seen. This is, I think, a bit of a truer number. But a lot of this is driven based on just, as we said, Russia. Russia's putting crude oil in storage in Ghana, in Turkey. They're struggling to find places. So, at the same time, did they turn on their AIS transponders? Did all of a sudden some of these vessels go dark and now they're not dark anymore? And that's where you can get some of these unknowns really impacting some of these underlying numbers. Asia floating storage moving higher, but again, it's still at the low end. As we think it'll move a bit higher into closer to 2022, but not much in any meaningful direction. This isn't something where you look at this and say, oh, clearly, you have to sell crude down $10. No, it's elevated, but kind of normal versus the new setup that we have going on, especially when you look at some of the Asian demand figures. China super tankers, fairly normal. And that's why there's this view that China is going to absorb a significant amount of product and more importantly, crude. And the boats aren't saying that. They're stronger, but again, they're where they were in 21 and 22. And as we've been saying, we expect that. We expect that to be the case given they've built a lot of refiners. They have a lot of throughput at this point. And when you look year over year, the throughput in China has only increased 100,000 barrels. And again, that's not a huge sweeping view where you're going to, China's demand is so high, they're going to sweep the market. No, it's going to be pretty balanced. And that's going to, again, why we think we're range bound, why we don't see this big shift. China demand continues to be elevated. You can see it's coming down, but again, very elevated versus 2019 versus last year. And it'll continue to normalize, but it's still going to stay strong. People were locked up for a long time. There's going to be movement. It's just how long does it last, and does it impact the energy markets realistically? One of the things that we've been saying is that Shandong was going to stay strong. It's staying strong. Another increase from 64.5 to 65.7. We expect it to get and remain elevated. The bigger issue is the state-owned refiners, and that's where when you look at the aggregate utilization rates, they're a bit lower, and it's because of that there's a lot of product in storage. They have to clear that product. Do they do it by export? Do they do it by selling internally? Clearly, there's some of that increase internally, so they haven't had to dump it outside. But net, when you take in the Shandong, when you take in the state-owned, run rates are only 100,000 higher than last year, 100,000 barrels a day. That is not a market where you're sitting there and seeing all of these excess barrels in the world. You know, if run rates were 1 million barrels a day bigger than they were previously, you're going to see a shift. If they were 600,000 barrels a day, you're going to see a shift. We're just not seeing that. And we could, and this is why we look at the data weekly. We could see it. It's just based on everything we know about the Chinese economy. It doesn't look like that is going to be a likely impact, which is going to, I think, disappoint the market. West Africa floating storage at the high end, but again, still within the cloud. Not too much to say one way or the other. We do see additional flows coming into the U.S., some actually additional going into China, but they raised, you had some diffs going up, and that slowed down buying, and now you're starting to see some of those differentials come back down. U.S. exports, gasoline down 117,000 a day, distillate down 13,000 a day. Propane down 104, but propane is the one that's going to stay very robust, just given the shift that is happening in the world. And then you have a gigantic makeup number on the export, crude export side, which again is part of the reason why you see the adjustment factor the way it is, because it takes time for the export and the import numbers to balance out and to clear. And this is, again, a big makeup number because we physically can't export 5.6 million barrels a day. It physically can't happen. But there's timing delays. Were they lightering a VLCC? Was there some delays in filing some of those VLCCs? And that will result in some of these surges, which is why we talk so much about the 4-week rolling average. Gasoline continues to drop below the 5-year average. Given the Russian shift into our markets, this is something that will likely stay now below the 5-year average. We were expecting to be right around. This is going to put a bit of a damper. And the same thing in distillate. We're going to have some headwinds, and it's going to stay below the 5-year average, which is going to result in more storage for both, which again is going to weigh on underlying spreads. Crude oil exports, you can see here the nice big surge. And then when we look at the propylene market, still staying strong. Again, we don't see that changing in the near term. Ethane continuing to remain elevated. Again, it's going to stay well above the 5-year average and just sit at the very high end of that cloud, if not above the cloud. When you look at Fujairah, they reported 21.896 million barrels in storage, 515,000 below the versus last week. Light distillate fell 958,000 barrels. The East of Suez gasoline complex softened in early trading as gasoline inflows from the Mid-East continued to bolster Asian supplies. Some markets expect Asian gasoline inflows from the Middle East to be as high as 3 million barrels in March. However, others think that the Chinese flows could offset some of this. So you're going to get some of this back and forth. What we see is light distillate's going to build. It doesn't build in a straight line, but we do see more builds coming over the next few weeks, just given some of the flows and changes from that Russian product, as well as that slowing demand in general. Middle distillate decreased 443,000 barrels from last week. East of Suez gas oil market was range bound. And you're getting this lackluster cross-regional flows and the receding east to west arbitrage economics. And that's where we see some of the builds here. It's just because we're starting at such a low level, even though you're going to get builds, they're still going to be fairly muted in the broad kind of stroke of things. And that waning arbitrage economics weighed on South Koreans' exports as buyers in the West had stockpiled barrels in December ahead of those Russian sanctions. So again, there's a lot of these shifts that are going to be very fluid, and why we talk so much about some of these underlying changes. Heavy resid had an increase of 886,000 barrels a day to just to 13.2 million. Spot trading activities of the bunkering hubs were fairly mixed, and just again, given some of the softness in trading, shipping and trading in general, we don't see that changing too much. Brent time spreads, when you look at May, June, again, at the higher end, but still a bit within this point, the 60 cents. We don't see it going back above. If anything, it's going to stay a bit flat at this point in time. When we look at Angola, their final numbers for April, it came out after I pulled this down, 1.1. Again, not too much of a change. So when you look at some of the different filings, Libya is going to stay at about 1 million. That's something that I think we've been talking about, the market's been talking about. Nigeria, again, we should see some of these additional flows. They were producing a bit higher. Norway, something similar. So Russia is going to be the biggest swing here. Realistically, we think they tried to hug the 4.7 million barrel a day number. It'll likely sit at 4.5, but they are definitely going to try to be as high as they can. The question is, as they now have to export product, are they going to have to kind of go back and forth and balance it up and down, because you can't do oil and oil and product from the same slip at the same time. You have to look at what boat you have in front of you. Vital offered Dahlia at a deeper discount to dated Brent. West Africa's crude exports to Asia are set to edge slightly higher, but again, still very much at the lows. Vital can't clear this March cargo. They've now dropped the price to $1.05 less than dated Brent. It was previously $1, then it was and then even at the start of Feb, it was actually 55 cents above dated Brent. Now it's $1.05 below. And again, this kind of back and forth of trying to clear these things, because some of these buyers have disappeared. 43 cargoes of crude are due to load for Asia in February based on the early data sets, which equates to 1.43 million barrels a day, which is revised slightly up from Jan of 1.4. But shipments to China dropped 689,000 barrels a day. It was the lowest since July. Shipments to India went up from 216 to 311, but that's still the lowest level since June 2020. So that's what we're saying, is that even though India rebounded, you're still well off lows, still well at the lows, and that's why we see so many cargoes just sitting in the market, and why we sit here range bound. There's nothing that's telling us that we're going to see this big shift. Genscape, when you look at crude flows, storage fairly flat. We already talked about this just because we filmed on Thursday. Here you can see that gasoline, small increase. Again, gas oil, small increase, nothing too crazy. Gas oil just moving higher, getting closer to normal. And a lot of that was just preemptive for Russia. Gasoline, record high, is going to have to move it into the market. And it'll likely come into pad 1 or the East Coast as fuel oil continues to struggle. And a lot of that is because the fuel oil used to go to Asia, Africa, and a lot of that product or demand is being taken by Russia. Now, when we look at some of the shifts in Singapore, some of the key areas here. So Singapore, small build as we showed last week, but nothing real meaningful. The build came in middle distillate. Light disti had a sizable drop, but again, we think that's going to reverse, because even with the drop, you're still well above 2021 levels. It's the only time we were higher was at 2019. But again, we think that that's going to stay at the very high level, with middle distillate, grinding a little bit higher, and that's going to get more pressure from the middle distillate side, as well as the resid and heavy disti side, as that Russian product comes into market. North Sea still staying on the low end. As you can see here, the floating storage is zero just because of some of these movements. And then when we look at Europe, here you can see Europe moving down, which is why on the floating storage side, which is why we do see some additional increases, especially as we've been talking, some headlines have come out where we're getting some additional run cuts and downtime, unplanned and planned in Europe, which again is going to put some additional crude in storage. And as you can see from the floating storage to storage, land storage, timing delays, fun times ahead. So that's what we have for you today. If you have any questions, you can find us on the comment section. You can find us on Twitter. And we hope you have a great day. Thanks again for watching. I'm Mark Rossano, founder and CEO of 66 Capital Holdings, coming to you from Primary Vision Network.